Hello students, I'm Selina Tupua from the Curriculum Advisory Services. This is another Year 13 accounting lesson on Strand 3 Company Accounting, and it is lesson 2 on Substrand 3.2 Formation of Companies. The Content Learning Outcome, or CLO, discuss the accounting for the formation of company. This lesson is about the 9 steps of preparing the journal entries for the issue of shares. So we are going to use the example that the question that we used for as an example for lesson 1. So in this example, the authorized capital was $70,000 and the issued capital was $60,000. The application due and receipt was $24,000 and the allotment due and receipt was $18,000. Call 1 was $12,000, but not all the $12,000 was received when call 1 was due. We will discuss that more when we look at the journal entries. And call 2 was $6,000, but it was not made and it was not due to. So it was not received. So let's look at step number 1. Step number 1 is to record the authorized capital. So from that, the question in the example, JJ Company Limited was registered with a capital of $70,000 at $1 per share. So the date that will appear on the journal is May 1st. And the entries for the authorized capital are unissued capital debit and authorized capital credit, 70,000. Unissued because even though it's authorized to be issued, but it's not yet issued. So it's 70,000 debit and the total of the authorized capital credited, which is 70,000. And step number 2 is to record the value of shares to be issued. Of the 70,000 authorized to be issued, 60,000 was actually issued by the company. So this is to record the amount of share issued. So we will not be using the entry as issued capital. The date is same as the registered or the authorized capital, May 1st, and the entries are uncalled capital or equity receivable and unissued capital. In the first entry in step number 1, unissued was debited. But now, since the shares are already issued, it will be unissued, will be credited. So the account will cancel off. So a debit entry and a credit entry together, that means there will be no balance left. Why there is no balance? Because the shares were all issued. There was no unissued capital. And debit uncalled because the value of the shares is still not called yet. So that's why the uncalled capital is debited and the unissued is credited. So step number 3 is to record the money received on application. So the application money, the application due was 60,000 multiplied by 46, which is 24. Step number 3 and step number 4 are both happening on the same date. So even you can have step number 4 as step number 3 and step number 3 as step number 4. So the actual money, because the application and the money received at the same time. So when the application, the written application is sent to the company by those interested shareholders, they are also sending the money due on application at the same time. That's why it's taking place on the same day. So the company is expecting to receive all the application money on that same day. So the cash that was received from application is $24,000. Okay, it's debit cash at bank share trust. Why share trust? This is a temporary account. So that money, when it's received from application, it's kept in a temporary account, which is called the cash at bank or share trust. This is done so because the shares that are applied for, even though the money has been received during application, it's not confirmed yet who's going to get those shares, whether the application, whose application will be successful and whose application will not be successful. So they put it aside just in a temporary account in case those applications, some may not be successful, their money will be returned. So it's just there on a temporary temporary account. So debit cash share trust 24 and credit application 24,000. So that shows that that money is coming from application. And step number 4 is to record the amount due on application. Of course, that the amount due is same as the amount received, which is 24,000. So debit application 24,000 and credit uncalled capital 24,000. And that application is debited. In the cash received from application, it's credited. So again, this is another example of an account that will be closed when it comes to ledger posting and balancing of the account at the end of the accounting period. Because when the application is due, it's debited. When the application is actually received, it's credited. So the application account will be closed. So it shows that there'll be no more balance left on application because the money that was received has been, it will be kept aside. So nothing, all the money has been received on application. So debit application and credit uncalled capital of the same amount of 24,000. And step number 5 is to record the amount due on allotment. The directors allotted the shares on the 23rd August. So when they received the application on the 16th of July, they from there they chose whose applicants, whose application will be accepted. So they've decided that that on the 23rd of August, that the application will be allotted, the shares will be allotted. So the total amount of shares allotted is $18,000. So that's so the amount due on allotment is $80,000. So debit allotment and credit uncalled capital. Remember, it's just due, it's not yet received. So this is a total of allotment, the shares that was allotted. And step number 6 is to transfer the balance of cash at bank, share trust to cash at bank account. This is done immediately as the shares are allotted. So this is for sure. See, the money is going to be transferred to general. There's no more temporary account. So it's confirmed that those shareholders who applied for the shares have been accepted and they were allotted the shares on the 23rd of August. So the temporary account that the money was transferred to on the 16th of July will now be closed because on the August 23rd, the entries of the transfer of money from general to cash at bank will be debit cash at bank general and credit cash at bank share trust. It was debited, share trust was debited on July 16th. Now it's credited. So when you do the balancing off, this account will be closed. There's nothing left in the temporary account. Why? Because now they have transferred the money to the permanent account, which is called the cash at bank general. So that's when the allotment is actually given out to the shares, it's actually allotted to the shareholders. In step number 7, so that has to be done. So straight after the allotment is due, the transfer has to be done before the allotment money is expected to be received by the company. So that was received. The allotment money was received on the 20th of September. So the journal entry will be recorded on that date, on the 20th of September, the date in which the allotment money was received. So debit, cash at bank general, and credit allotment. So in this way, the allotment account will be closed because when the allotment was due, it was debit allotment and credit uncalled. But in this entry, the allotment is credited. So a debit and a credit of the same amount will just cancel off and will close off the account. So there will be no balance of allotment at the end of the accounting period. And we look at step number 8. Step number 8 is to record the amount due on call. The directors made the first call on 1st October 2020. So that means only the first call was due, and that was $12,000. So on October 1st, it's debit call number 1 and credit uncalled capital. Call number 2 is not yet due, so we will not record call number 2, only call number 1. And the last step is to record the amount received on call. There will be no money received on call 2, only on call 1. So on the 31st of October, first call monies had been received with the exception of the amount owing on 400 400 shares. So to calculate that, the value is $80. So the account affected, the entries on October 31st is debit cash at bank general and credit call. So you will notice that the 12,000 was not received. It was less by 80, so only 11,920 was received because the 80,000 was the unpaid call or the call in arrears. So we have come to the end of our lesson, whereby we were looking at the general journal entries for all transactions during the issue of shares. So I hope you remember the journal entries. So during the issue of shares, when the company is forming for the first time, so the formation of company. So we start off with the authorized capital. So the entry, can you still remember the entries for authorized capital? It was debit unissued and credit authorized capital. And then we recorded step number 2 was to record the issued capital. In the issued capital is there where you use the uncalled capital or the equity receivable. So it was debit uncalled capital and credit unissued capital. So if you are to prepare the ledger accounts, it will cancel off here because in the first journal, it was unissued capital was debited. In the second journal, it was credited with the same amount. And then after that, the step number 3 and step number 4 is to record the amount due on application and amount received on application. And step number 5, the allotment due. So the allotment due, after the allotment due is recorded, and that is for sure that the shares are allotted. The next step was to transfer the share capital, share from the cash at bank share trust to the cash at bank general, because now for sure there is a permanent account for cash, which is called the cash at bank general, and the cash at bank share trust will be closed now. There will be only one account because the shares are allotted. And then the next step was to record the amount received on allotment. And the journal entry for that is cash at bank general debit and credit allotment. And then the next step was to record the amount due on call. So it depends on how many call. In this case, there was 2 calls. Only call number 1 was due, so debit call number 1 and credit uncalled capital. And the last step was to record the call received from call number 1 received. So in our journal entries, we did not receive all the calls, the $12,000. It was short by $80 because the $80 was the call in arrears. So there was no separate journal entry for call in arrears. It was accounted for when the actual money for call number 1 was recorded, and there was no call in advance. So we have come to the end of our lesson, and I would like you students to do activity 3.2.4 on page 89 of the senior accounting year 13. So you practice, you go over this lesson once again, and then use that question to practice what you learn, and you can refer to the example that we use in this lesson to help you, to guide you in answering that activity 3.2.4. So thank you very much, students, for watching and listening. So take care of yourself and stay safe.